Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA podcast series, and today's guest is Larry Williams. According to Williams, survival is a function of adaptation. Larry Williams has been trading for almost 50 years and is one of the most highly regarded short-term traders in the world. Larry has taught thousands to trade, won several trading championships, and since 1970 has been writing best-selling books based on his technical indicator, Williams Percent R, developed in 1966 and still published daily in major financial newspapers and on finance and investing sites. Between trading, researching, and developing trading tools, he ran twice for the U.S. Senate and was a board member of the NFA and has received numerous awards, including Futures Magazine's first Doctor of Futures Award, the Omega Research Lifetime Achievement Award, and Traders International 2005 Trader of the Year. The mayor of San Diego declared October 6, 2002, Larry Williams Day. Larry has been featured on CNBC and Fox News and has been interviewed and quoted in more publications than he can keep track of. Welcome to the program, Larry.
Thanks very much. Glad to be here today.
Now, anybody familiar with your work knows that the fundamentals of your trading have not changed in 40 years, yet you continue to innovate as the market changes with fresh indicators and angles on the market. What drives you to break new ground, and how do you know when it's time to push in a new direction?
Well, there's a couple different points. I think the reason you continue to do new indicators is because you weren't very wise when you began doing the old ones. That you continually learn more about the markets, and with that, hope for more information. You have different insights into do it and what may work. But another really important part, I think, is that one thing I really realized after doing this for half a century is these markets change. Markets I trade now, I wasn't trading 20 years ago. 10 years ago, I wasn't trading some of these markets. And now we have electronic markets. So things are always in a state of change. So it could well be that what works in the past, if it's just very technical, may not work in the future because you have open outcry markets are gone. You have different contract specifications. We're always evolving in these markets.
Let's talk about sentiment, because people don't really change. But for years, the only way to get accurate sentiment data was through polling investors through phone call and faxes in the old days. And even then, you'd only cover the major indexes and commodity markets. But several years ago, you tried to build a better sentiment mousetrap. Can you tell me about that?
The original work was done by Jim Sibbetts at Market Vein. And Jim has a really brilliant idea of just checking with the advisory newsletters to see how many were bullish or bearish on individual commodities. Jim didn't do stocks. And that has a pretty good record. I think it still continues to be run. In fact, Jim passed away a few years ago. But bright guy, had some good indicators and some great ideas. So the idea is, how do you carry that on? Well, we know Investors Intelligence also has a weekly reading on the stock market based on the number of advisors that are bullish or bearish. We just wanted to take that idea on out to individual securities and future contracts. And there's a couple of ways of doing it to get a sense of the advisors or what the crowd is doing. One would be to use the COT small speculator position. Another would be to use option spreads and ratios, because you kind of get an imbalance in there of the public. So kind of putting all those things together in a Kuznets blender and turn it on for a minute, and you get an idea of when most people are bullish or bearish on the market. And clearly, while the market's changed, as I talked about a moment ago, they're always in a state of flux. You're absolutely right. The one thing that doesn't change, they're still traded by people. And people are still emotional, and people still seem to buy at tops and sell at bottoms. So interesting, you listen to someone like Ned Davis, who has just a fountain of knowledge of the markets, and I think Ned has often said that the best indicator that's held up the best over years has been sentiment indicators. That's the bedrock, I think, really, of this business in terms of technical stuff. So I think it's really critical that we pay attention to sentiment. It's a marvelous index.
how long have you had your sentiment indicator that you can, and you said you can apply your sentiment indicator to individual stocks?
Yeah, it is. In fact, we have it in TradeStation on individual stocks. I started doing it in a book I wrote for Bloomberg in 1999, or a chapter in a book called New Tools of Market Traders or Masters or something. But so we have a good long history of the data, and a lot of people have used it throughout the world, and it's really popular simply because it works.
Now, back 40 years ago, you really started breaking ground in seasonal influences in the market, and you've also done a lot of work on cycles. What is the difference between seasonals and cycles?
Let's talk about seasonals first. Seasonals are based on, especially in commodities, production cycles and demand cycles. So we know usually wheat has usually bottomed in July and had a rally. It's probably because of the harvest coming up in the fall. Lumber usually bottoms in March. There's a turning point in March because that's when people get out back into the woods again. So there are actual physical aspects. Even gold, believe it or not, has a seasonal, probably because most, not all gold now, but especially in the past, most gold was at high altitude in mines that were shut down in the wintertime. So there are these seasonal influences that apparently cause prices to move up and down based on weather, if you will, and commercial usage and storage of a particular commodity. Then there's need to have a demarcation between that and cycles, which are just long-term, in my view, waves, if you will, or cycles of when markets seem to get very emotional and start to rally, or people get depressed in markets and start to decline. Well, exactly what causes those cycles, I don't really know. Everybody's guessing all over the place. Are they there is my question, and I think that they are. I think that we can demonstrate that there is a pattern of how markets perform, and we can do that a year or two in advance. But both cycles and seasonals are not mandatory. They're suggestive of what's going to happen. The news of the day accentuates the cycle or the seasonal. So still what's happening right now is critical. But the cycles will tell us, like right now my cyclical work is saying we're really close to a significant high in the stock market. We just need to see the market trend change in here. Then the news will come out, but the news will perpetuate and see how large the decline will be.
So what kind of cycle indicators have you developed, and how do you use them?
I haven't really developed anything terribly fancy. I do a lot of cycles work. I think you can do a high-powered math, which I don't really understand very well. I've hired high-powered math guys to help me, but it really all gets down to doing rates of changes, I think. That's basically what a rate of change is going to show you what the cycle on the market's been. Just smooth it out with math a little bit. And it seems to me that there are three cycles dominant in the market on, say, daily charts for stocks or commodities. And you really have to put them all together. I'm just grabbing numbers here, but there might be a 14-day cycle and a 28-day cycle. But one may peak while the other is troughing. So you really need to add those together to get the impact of both of them, and then bring in a longer-term cycle than that. When you get all three of those together, pretty well gives a pretty decent forecast or roadmap of when this next cyclical high or lows will form in the marketplace. Not perfect by a long shot, but most of the time the cycle forecasts will say we're going to have a turning point here, we're going to have a turning point there, when these cycles kind of nest or crest, if you will, all together at the same time.
And are you able to use this as a primary indicator or as a secondary indicator when you had mentioned the stock market approaching a peak?
I'd say we'll call it a warning or a setup tool. And so like right now I'm in let's call it a danger zone for stocks, should start to decline in here somewhere in the next 3-4 days. And so then I'm really on high alert to take sell signals, and I have to be very cautious of my buy signals, be cautious of false breakouts, things of that nature, because I know I'm at a zone when the chances of a decline are substantial. or a rally, whatever the case might be. So it really focuses my attention is what I use these for.
Okay. Are some markets more sensitive to cycles than others? You had mentioned commodities because there's a planting and a harvesting season. Are they more sensitive than maybe a stock or a bond market, or are they all?
Unfortunately, they're all pretty goosey. We can have these great projections of the future, and they don't always come true. And I think that's because the news of the day comes in, and because we're still learning how to project markets. But and there's so much random activity. That's why I think a lot of technical analysis is just chasing the wind. There's so much random activity that we cannot account for, and I certainly can't account for it. But it still gives us a sense of when we should have an expectation of the future, which is really an advantage for a trader. And I'm happy if I can get any type of advantage in this business.
Sure. Now, I know you're a big sports fan, particularly boxing and mixed martial arts, and you draw some parallels to the trading world. You've been quoted as saying that the right dosage of fear and confidence create aggressiveness. There comes a time in every trader's life, about once a week in fact, when you have to get aggressive, either in protecting yourself or asserting your market expectations. My question is, how do you discern when it's time to jab and when it's time to cover your face?
If you're getting hurt, as soon as you start to feel some pain, you better get aggressive in that. You better protect yourself. But there's another in the markets also a point that is, I think, even more important. Invariably, when I feel like I'm really rolling in the market and doing really well, I get too aggressive. And the analogy would be in a fight game where a guy is just doing great and he leaves himself open and he gets knocked out. And that same thing happens in trading, that it's just real rolling. It's just doing great. I had a spell last year, a streak, just like a phenomenal streak in the marketplace. And then I just got too aggressive. My bet size was too aggressive. I had too many trades on. I had that what I call King Kong feeling. When King Kong climbs the Empire State Building, he's got the beautiful girl in his hand. He thinks he's in control of the world, and he gets shot. And you get this King Kong feeling in the markets a lot, and you have to be really careful of that.
You've also said that great traders are like great athletes and that they have the ability to score when they're behind. Great traders have the ability not to blow up when they start losing. What do you personally do during difficult times?
Drink. It's very frustrating to go through difficult times. I've gone through a lot of them. One thing is to stop trading or slow down your pace. Another is to check and do more research. I think losing trades have caused more good research to be done than anything else I know in the market. It always puts you back to your desk to work. So it's productive to have losing trades, and I think you need to have that perspective that losing trades are just that. They're not you. That's not your personality. It's just something that happens, and it should be something that instills in you a little work ethic to go see what's wrong. But the big thing is, once you're starting to fall apart, or it looks that way, you really need to cut back your trading style, and not only the frequency of your trades, but the number of positions you have on. And then as it starts to get better and pace picks up, you get back to your pace. But then when you start running real fast again, as I mentioned, you better be careful.
So would you say that this is a natural ability, or is it a learned ability?
I think some people have it naturally better than other people, but you better learn it for sure. You have both. I mean, I have a feeling that virtually all people that trade the market, we're so unique from other people in that we're willing to take on risk, and most people aren't. So our emotions are very different than the average guy in the street. And that's why we got into the market, and that's good. We are risk takers. That's a beautiful thing to be in life. But also, your strength is your weakness. And the strength of being a risk taker means you may take on too much risk or not caution yourself when you should. So you really have to be balancing out that yin-yang in your life of, I'm a risk taker, but not too much risk.
You've talked about winners versus losers, and there's not a lot of difference between the two.
In individual trades, you mean?
Oh,
Traders?
just the psychology of the trader. They both work hard.
Oh, yeah. What I see happening is that good traders put in as much time as losing traders. But the big thing, I did a study years ago, and the big thing that we found out was that the successful traders took care of their losses. They managed them. And the unsuccessful traders, they worked just as hard at it, but they let their losses get away from them. They weren't any smarter. And I've seen some brilliant people that try to beat the market, and they haven't succeeded for one or two reasons. One, emotionally, they get screwed up, or two, especially the mathematicians, math is pure. 2 plus 2 is always going to be 4. They bring that into our business, the markets, and they think that they can take their purity and make the markets pure, forgetting about randomness. And then they have these great mathematical, let's call them optimized systems, neural networks, artificial intelligence, whatever, and they think they've solved it and it blows up. And that's because they're mixing their metaphors, if you will. So I think intelligence alone doesn't do it, that's for sure. I've known some guys that were basically not that bright that have done very well in the business. But their strength is that they're bright enough to know they're not bright. They're bright enough to know that they don't want to make this too complex. They just have a simple, hey, come straight ahead and take the trades. And that's the mindset. I've worked with a lot of people. Lawyers seem to have the most problem because they want to argue. They don't want to just accept things. And it's a lot about acceptance to be successful, I think.
Correct me if I'm wrong, but you have a law background, don't you?
Yeah, I have a law degree from a correspondence school. I wanted to be a lawyer, and so I did pass the California baby bar exam. Worked in a lawyer's office for a while, and I said, "This is the most boring thing I've ever seen. This is not being Perry Mason in the middle of a trial." And by then, my trading was doing pretty well. I thought, this is really what I should be doing in my life. The discipline of law was great. To learn how lawyers learn was a wonderful experience, but I would a lot rather trade.
So you're saying there's hope, even if you're intelligent, you can overcome it.
Yeah, I guess that's right. That's always been my strong suit. I'm never very intelligent. I'm just like, oh, okay, you can't get too sophisticated. I see people all the time, especially at technical meetings, they have 15 or 16 different indicators in the old day on their charts or now on their computers. I go, what are you doing, mate? I mean, come on, how can you make a decision? You got 15 things to look at. That's too much. You got to simplify this stuff. They all say the same anyway. You can take Williams percent R, 14-day Bollinger Band percent R, 14-day Bollinger B, or RSI, 14 days. They all do the same. They all look the exact same on your chart. There's no difference because they're all using the same time frame. So you really have to make certain in your technical analysis that if you're going to use a couple of different indicators, that since they all say the same, you better at least adjust time frames, one being different than the other, so you get a different cyclical view of what's going on.
Now, your son, has he done some research on the psychology of traders?
Yeah, Jason has. Jason is a psychiatrist at Johns Hopkins in Washington, or in Baltimore, and now is in private practice, and did a book, The Mental Edge in Trading, and it was really interesting. At Hopkins, they've developed a personality profile that is applied throughout the world, has been for quite some time. It doesn't matter race, religion, creed, sex, any of those things. It really gets the heart of the personality of that person. And so Jason said, hey, Dad, we should do this on traders to see the difference between the winning personality traders and losing personality traders. So hopefully a losing person could understand where his strengths and his weaknesses are and his personality to get to the winning side of the game. So I gave Jason names of friends of mine that are highly successful traders, manage billions of dollars type of people. And Jason interviewed them, gave them the personality profiles, and they were fortunate enough to cooperate with us, with Jason. And then he did an analysis, and that's what the book is about. And I think it's groundbreaking in that it's real science. It's not mumbo-jumbo, psychobabble stuff. This is real. And he did find that there are three major aspects that are different in the personalities of the massively successful traders.
And this book is available now?
It's on Amazon. Yep.
What's the name of it?
The mental edge in trading, or gaining the mental edge in trading. It's by McGraw-Hill, Dr. Jason Williams.
And you alluded to your market view, but can you give us your view on what's in store for us?
Yes, I have a really strong view that over the next 15 days the markets will fluctuate.
It might be 15 days before this interview is even released. So that forecast is probably good even beyond that?
That forecast is in perpetuity, yes. That forecast will work now and forever, as always. The market, what it's going to do is going to seek to destroy the most number of people it possibly can. But in terms of a broader picture, we're doing this now in the 17th day of January. I would think that prices will move lower from anywhere in the next couple of days here. That we will start a pretty significant move to the downside with a rally coming sometime late March. But February, rest of this month, February, March, I think we're going to see a sell-off in the market.
Okay. Now, in closing here, I see that your name was added to the speaker list, a rather distinguished list of speakers for the MTA Symposium coming up in April 2013. And very excited to see that you're able to make that.
Well, I'm really thrilled about being there. I don't know why I get invited to the MTA stuff because I don't believe much in technical analysis. So this is going to be fun. I will bring the house down one way or the other.
Are you looking to ruffle up your feathers?
Oh, absolutely. I mean, why go to a bar if you can't get in a fight? That's the old Montana cowboy attitude. I mean, why go to drink? Come on. There's some other dude in there. My dear friend for so many years, Tom DeMarco, will be there as well. Tom likes to ruffle feathers. He does it much better than I do. He is the original agitator like Howard Cosell was in the sports announcing. And I think Tom and I will, not only will we ruffle some feathers, we're going to show some things people have not seen before, some ideas they're not aware of about technical analysis, where it works, where it doesn't work. So I think it's going to be a great learning event, and there's such a wonderful group of people there. It'll just be a great time as well.
Well, I thank you for your time today, Larry. Is there anything you'd like to add before we go?
Yeah, you bet. I think the most important thing in the market I can tell people is bet small to win big. Just don't ever bet big. And the whole idea is to catch small bets and catch large moves. That makes money. Most people are having large bets on small moves. Eventually, one of those large bets is going to blow up. So not a business to rush into. Take your time and manage your money, and success is there.
Okay. Thank you, Larry. Today's guest has been Larry Williams, and that concludes today's MTA podcast. From LexingtonCapitalLLC.com, I'm Lance McDonald, together with recording engineer Shane Skwarek at the MTA, reminding you that price is always right.